Why do humans make terrible traders? Now, I think the answer is simple. I'm going to tell you. And then what you need to do as a trader is acknowledge why humans are innately bad traders and make some actions to overcome those traits. Okay, so why are humans terrible traders? Well, I'll tell you right now. It is in our prehistoric DNA to avoid danger. I don't think you can deny that, to be risk averse. If you watch the Croods movie of the cave dwelling family, the first scene is the epitome of risk averse. So why does that make you a bad trader? Well, there is a direct correlation between risk and return. Without low risk, low return. It's fact. You cannot make a high return from low risk. Doesn't exist. Fact. So you must seek out high risk for high return. It's a simple math equation. And high risk normally means high volatility. High risk, high volatility, high return. Humans are the thing that means that we're still on planet Earth is because we are genetically risk averse. All the high risk humans are dead. Okay, that's trait number one. Trait number two is if you do manage to overcome that, we then have an affinity to gambling. So by this, it's that one shot, it's that 100 to 1 horse race, it's that 1,000 to 1 horse race. It's why, if you think about the lotteries around the world, there's more chance of you being struck by lightning than winning the lottery. So if we were logical humans, when the lottery games came out, what's my chance of winning? 1 in 25 million. Oh, okay, I won't play. That is the correct logical approach to the lottery, because there doesn't even need to be a winner. Yet, many millions and millions and millions of humans play the lottery because they want that $1 in, $400 million out payout. So we have these two, and well, just to labor on the fact, gambling is massive business around the world, where Vegas, you statistically, if you play Vegas long enough, will lose money. Yet, we all go there with the mind fallacy that, oh, maybe not me, because I have a strategy, I have a plan, I have a way of playing, I'm going to win money. It's just not true. It's cognitive dissonance. So to become a good trader, one, you can't gamble, and two, you must seek out the risk. So you've got to overcome your risk-averse nature, and you've got to not gamble. I mean, how are you going to thread that needle? Because that's not easy. That's not an easy thread. So let's look at the first one. How can you seek out the risk? Well, from personal experience, the way I like to approach it is when you put your net worth or whatever money you've got into trading and it goes deep red and you're losing money, that's when you're most likely to fail at the trading and investing game. When you're in the green and positive and things are all good, you literally want to double down. You want to triple down. You can't put enough money in the market. As soon as it goes against you, those self-protection mechanisms kick in, and it's only when you've been in the deep red that you've had that question asked. And unless you've been in the deep red, you won't really know, you won't appreciate what I'm talking about. But one day you will be in the deep red, and it'll be then that you'll be asked the question: are you going to liquidate and lose a large proportion of your money, or have you set up your account so that you can hold out Because if you look back in history, all previous crashes, every single one, looks like a blip, a tiny, tiny blip. Because a decade later, 2 decades later, it's a blip in the past. Every single one. That's if you're looking at the S&P 500, for example, or the US stock market. So how do you not fall victim? Because I have been close on a number of occasions to liquidating, and the key has been not betting too big. It's in having a portfolio that, even though it was painful, was not cataclysmic. Many pro traders now in their 60s and 70s that lived through the 80s crash, the noughties crash, the 08 crash, the COVID crash, they all lived to fight another day. So you want to avoid leverage. You want to avoid going all in. You want to avoid your lottery ticket moonshots. Investing and trading is a long term, it's a lifetime pursuit of incremental compounded gains. So you need to invest well within your means. So for example, if you have 100,000, it's very easy to get leverage and trade 200,000. Well, if the market drops 80%, you're done. So if you apply any leverage at all, to survive long term, you need to be almost zero leverage, that is, so that when the market does collapse, which it always does, we don't know when, but we know at some point it will drop significantly, and you need to be able to hold. If anything, you need to be able to buy into these drops. So that's number one. How do you not gamble? Well, you need to see this. You need to approach trading and investing like a business, like you're a professional, not like a moonshot. You can take a tiny proportion and take your moonshot tickets, like in a previous video. I do it. I try and find the new Microsofts. I try and find the new Amazons. I try and find the new Bitcoins. I try and find them today at $1, or they're literally on the start of their ride. Many will fail. So you just put the smallest, divide it by 10, divide it by 2, and halve it again into your moonshots. Everything else, you need it in strong, stable stocks and spread around like crazy, like the S&P 500. If there's not more of a perfect distribution than the S&P 500, I don't know what is. I have an example. A friend of ours, she sold her flat, put it with a financial advisor. He invested the money, and on one particular day, or at some particular moment, I think she was down 10%, maybe 12%. She freaked out. So let's say it was $200,000. It was now 160,000. So she's like, oh my God, this is going to zero. She literally called him up on this day of her freak out and said, sell it all, give me my money back. And that's what he did. He took her out at 160,000 when she put in 200,000. She took the money out. She realized her loss, and I don't know, she's done something else with it. That is buckling, and she wasn't really that much down. I mean, if you can't cope with 200,000 down to 160,000, this isn't the game for you. That's a prime example of she wasn't mentally prepared for the risk and the volatility that comes with high returns. Had she now kept her money in, this was 2 years ago, she'd probably be at around 300,000. I don't know what she's done with her money, but I'm pretty sure it ain't 300,000. She's probably stuck it in cash and is slowly dying a death of inflation going against her. Because that's the other thing. You need to come to terms mentally that cash, month on month, even week on week, is becoming less. Well, hang on, what do you mean? If I had 100,000, I still have 100,000. No, you don't. You do not. You do not tell yourself that your 100,000 is still 100,000. Your 100,000 is now 99,000. What are you talking about? Well, hang on, I had 100,000. Yeah, you still have 100,000, but it isn't going to buy you what it could a month ago. It's going to buy you a little bit less because the price of eggs has gone up. The price of milk has gone up. the price of your phone has gone up, the price, everything. Our economies are designed to have inflation. Our economies are designed for you to spend your money. And if you don't spend your money, so by spend it, I mean either spend it on assets or you're going to spend it on goods. The worst thing you can do is sit on cash, because the cash becomes less. If you had 100,000 in 1990 or 2000 or 2010, you could buy a house back then. If you went, oh, I'll just sit on my 100,000 because in 2025 I'm going to buy a house. You can't buy a house now. That's probably your deposit, because over time the value of money decreases and quicker than you'd think. Literally, you could almost be throwing out, this is how you need to think of it, like each day $5 or $1 is being just literally incinerated if you sit on cash. So once you come to terms with that, that gives me the strength to buy assets. And by assets, I like stocks. They are dealing with, well, let's not go into the point of stocks, but the risk of stocks should pay out over the degradation of cash. And that's how I come to terms with putting my money at risk, because the risk of not doing it is greater. The risk of cash is holding cash is huge. That's how I come to terms with investing. I have another example. So she was investing, and then I have another example of a trader friend. Well, so he asked me, James, how are you trading? So I showed him. This is quite some time ago, around 2008, and I had a very structured method, and he was a good friend at the time. So I said, oh, I do this at this time of day. I come on, I analyze this and this, and I put the trade on, and and it plays out. And here's my return. I had a little chart because I was journaling every single trade and every single detail. And he's like, oh, that looks pretty good. And the chart was like jagged but up. I was making money. And I was like, okay, there you go, do it. So day one, he put the trade on, and he freaked out. It went red. So by red I mean it goes into a loss-making position, and he freaked out. And as soon as it got back to zero, he closed out. I only found this out afterwards, and like he was done. And the next day I saw him. I was like, oh, the trades came in. They came, it looked good. And he was like, oh man, like I was so much down, and as soon as it got back to flat, I closed the trade. I was like, why? He's like, oh man, no, I thought it was gonna like be a loser, so I took the trade off. I was like, okay, and have you put the trade on today? Because it's already won. Like it was like one of those expiring options trades. And he's like, yeah, nah, I'm not gonna do it. But yet, when I showed him my results, it was statistically proven, the strategy. Statistically, I had more than, 500 trades. I can't remember. I had hundreds and hundreds of trades. And yeah, you got losses, but you got gains. And over time, it was climbing. And there was nothing to suggest that on that day it was going to be anything other than a jagged climb. Anyway, he literally couldn't cope with the gyrations. And that again is, you need to mentally equip yourself before you invest and before you trade, and realize. And how I like to think of it as, I put in however much money today. Let's say I put to work today 20,000. So what I do mentally is I write it off. I've lost 20,000. That's how I think of it. And then any dollar I get back, so in either trading profits, or let's say I take some of the trade off, or I follow its climb over time, by writing off the money mentally to zero, everything is upside. And I really like to work that way. So let's say I do 100 trades on my 10,000, and let's say I make 1,000. Well, for me, I only now have at risk 9,000 because I've realized $1,000 in profit. Does that make sense? And then at some point, I'll have made $10,000 in profit, and then I'll be flat. I know I'll have 20,000 because I put in 10 and I've made 10,000 in profits, but I don't think of it like that. I think what I've done is I've earned back the money I put at risk. So now I'm guaranteed if I now lose everything, I can only lose the 10,000 I have at risk, not the 10,000 I've made. So then I always risk the 10,000, not the money I'm making. And that for me that's the mental, there's a cool word, that's the mental gymnastics I undertake to cope with trading. That's my little mental tool. So just with regards to gambling, if you like gambling and you can't, I know some guys just can't resist, leave that to your sports betting profile. Don't gamble with your investments. Pigeonhole them mentally. Gamble at the weekend with 20 bucks. Invest in the week with 20,000. That's how I'd approach it. You're looking for your investments and trading to be risky, but not gambling. So even high risk investments, like I made in a previous video about robots and AI and data centers and quantum computing, they're risky investments, but it's not gambling, because I structure the risk really small to mirror the risk profile of the trade. If any of this doesn't make sense, just ask me in the questions, because I've been doing this 30 years, and as I've said in previous videos, I don't know what you don't know. So to me, this will make sense. But so I'll try and paint a picture of what I mean by your risk profile. So quantum computing is all new. The companies don't make a penny, yet they're working on this quantum endeavor. So risk profile, let's say, is you've got a 1 in 20 shot of it, like one surviving, and maybe a 1 in 100 shot in being here in 20 years' time and worth a gazillion. Whereas, let's say Coca-Cola, I'd say you've got almost zero risk. The company is massive. It's tried and tested. It's decades old. It's proven. It's global. They can, even if people stop drinking Coke, they have hundreds of other brands that they own. They can just pivot. And I mean, I've only picked that one just out of thin air. You can pick all your Johnson & Johnsons, your Procter & Gamble's, your Mackie D's. Like, they are all tried and tested corporations that can pivot and have the money and the expertise. So those, I would say, like, risk is one to one. So you can put in your full-size trade. Your quantum computing stock that has no background, no history, no expertise, no veteran management, that's a 1 in 100 shot. So you size, if you take your Coca-Cola size, make it 100th, because that is the equivalent risk profile. So anyway, this is why a lot of humans, 99% of humans, make terrible traders. They are risk averse, they gamble, and they can't cope with drawdowns. In the good times, like I say, they're better than sliced bread. But as soon as they get called, as soon as they get tested, I've seen them, they just buckle because they weren't mentally prepared. Anyway, I hope that's useful. I hope maybe some of my mental models make sense, and that'll equip you for your trading and investing future. That's it.